What is up, money sausages? I am the money sausage, and today we're going to be talking about dollar cost averaging, what it is, and how it can make you millions of dollars just by investing. Now, before we get into today's video, I want to invite you to hit that like button and hit that subscribe button and the notification bell, because we are a growing channel and I want you to join me along this process, and I want you to be able to boost this video to the YouTube algorithm. Now, with that being said, let's get right into today's video. So what is dollar cost averaging? If you watch a lot of investment or financial videos, or even if you go to college and you're listening to professors talk, they may bring up the idea of dollar cost averaging. Warren Buffett dollar cost averages. So a lot of big investors do use this principle called dollar cost averaging. Now, what is it? Dollar cost averaging is defined as investments in a security at irregular intervals of a uniform sum regardless of the price level in order to obtain an overall reduction in cost per unit. And that's from Merriam-Webster, so that's a pretty wordy definition. So let's break that down. What is it? What does it mean to be investing in a security at regular intervals? Well, that means basically when it comes to having a retirement account or just an investment account in general, what you want to do, or even if you don't want to do this, you don't have to, but dollar cost averaging, you basically just buy in the same amount every month or every year, and you just keep on buying and buying and buying no matter what the cost is. So let's say you want to invest in the S&P 500 or the NASDAQ or an index fund or some sort of mutual fund. The one I'm investing in currently that I'm dollar cost averaging, here I'll put the name of the stocks here. I'm investing in VYM, which is the Vanguard High Yield Dividend Fund, SCHB, which is the Schwab Broad Market ETF, SWEPPX, which is Schwab Capital Trust, which is a Schwab S&P 500 index fund. And then I'm also dollar cost averaging into the Schwab High Yield Dividend ETF. So those are the stocks that I'm dollar cost averaging into, and basically what that means is each week I have about $20 going to each of these stocks, and I'm just buying $20 no matter what the price is. So I'm buying fractional shares every single week, and my portfolio is constantly building no matter what the price is. So usually when you get a lot of inconsistent returns in regards to selling when the stock is really high and buying when it's low, because frankly, you can't really predict what a stock's going to do the next day. So you may buy it and you're like, okay, I'm going to get 20%. It goes up 10%, and you're like, okay, I need to sell. You sell, and the stock goes up another 20%, and then you go to buy in because you don't want to miss on the more gains, and then the stock plummets, and then you're just like, well, shoot, so you sell. So it's just a messy train wreck. You're losing money. To be fair, if you're buying individual stocks and you don't want to dollar cost average into them, that's totally okay. If you know that something's going to happen, so if you know that some stocks are going to get a massive boost, like for example, if you know that a bill is passing to make all cars on the road be electric vehicles by 2035 or whatever year, then you should know that, okay, so this is going to start, these stocks here of these producers of electric vehicles are going to absolutely explode. And when you find out that regular car manufacturers are transferring to electric, their stock may even increase. So then that may be a sign, okay, so I want to start buying into these, and I just want to put $1,000 and see where it goes. So that's okay. You just buy and hold. But dollar cost averaging is a way of investing for very, very long-term investments. So index funds, mutual funds, Coca-Cola, just things that have consistent returns, 3M, Exxon, stuff like that. Things that companies that do have those consistent returns and that constantly have build up because they are such big corporations. So Disney, Netflix, sometimes I wouldn't say Netflix right now. Disney, for example, since they seem to keep on buying companies and buying more companies, and they just keep on growing and growing and growing. So stuff like that is where you want to dollar cost average. You want to put in a consistent amount. You want to put in a consistent amount for the same amount in a certain time period. So if you know that your goal is to invest $6,000 into the stock market every single year, dollar cost average $250 every other week. That way you're getting into the stock market for about $500 a month. And that way, by the time it ends up, you hit the limit of the $6,000 in a Roth IRA. And that's what dollar cost averaging is you put in $250 every other week, or put $125 in each week, and you just keep on buying. And that way you're buying on the upswings and you're buying on the downswings. And you just have that constant input of money, and you're buying up more and more shares. Some weeks you buy a massive volume for $125. Some weeks you're making a lot less. You're not getting as much money in regards to that. You're getting smaller fractional shares in regards to $125. But nonetheless, you're investing that $125. And obviously, if you want to invest in 5 different stocks, you can put $25 into each stock and equate to $125 in value. Now, you don't have to do that exact amount, but I'm talking about $6,000 as the goal, because I'm referencing a Roth IRA, because that's a great way to invest, because you will be a tax-free millionaire by the age of 65 if you're under 25. Now, if you dollar cost average, obviously you're buying the upticks and buying the downswings, so you're going to just see that consistent growth. So sometimes you may lose 3% over a quarter, but then the next quarter you'll gain 4%. So then you're in profit 1%. Then the next quarter but on the downswing, when it loses 3%, you're buying about 3% more stock than you are originally. And so you're going to be set up for when it has that 4% upswing, you're getting more money back. And then if the next quarter it drops down 4%, you go and you buy more. So it's just, think of it as a ship going across waves. When you go up a wave, you slow down. You're going up, and you're slowing down because of the friction of the water, but also the gravitational pull. So you're slowing down your payment when a stock is going up, but when it comes down, you're speeding up. You're increasing the amount. So speed in this example is going to be the amount of shares you're buying per dollar cost averaging session. So you go up, you're slowing down, so meaning you're buying less. But when you go over the crest of the wave and the stock starts going down, or the boat starts going down, you start speeding up. The boat starts speeding up, or you start buying more and more shares. And the inertia you're building on the downswing is going to really pay off, because once you get up into another upswing, you're going to be able to go up further, and you're going to still see a lot of gain, and then you're going to crest the wave, buy more and more. And it's just a very consistent way of making money and securing your investments in regards to long-term investments. So when you're expecting to see the 7% return every single year, you're going to see more and more returns. So that 7%, you may have more shares than someone that just puts they get their tax bill, they have $6,000, and they just buy in immediately. They buy in for the $6,000, and that's it. They cap off the account. But if they slowly buy in, use that $6,000 and break it up to like $125 a week, buying into stocks like that, you can get a lot more for your money, and you can see that a greater amount of return in regards to that average of 7% return. Which, let's say you started dollar cost averaging during COVID, when stock market was just collapsing and then had a massive resurgence. If you're dollar cost averaging, you got tremendous value from what you're investing in. And if you're investing right now, you're getting tremendous value, because we're in a recession. We've been in a negative percentage growth for 2 quarters, which is the definition of a recession. So if you would have started dollar cost averaging 2 quarters ago or 6 months ago, you would see a lot more returns on the investments now, because if the stock market comes out of the recession, we go back to, instead of going negative, we start turning positive, you're going to have a lot more stock in your pocket, and you're going to have a lot more in your wallet. Although worth-wise, not that much. You're going to see the worth of your stock keep falling. But if you don't sell, you keep putting money in, you keep investing, you stay faithful, you keep on putting in, and you keep on dollar cost averaging. Basically, once the stock market stops tanking and turns around and goes up, you're going to be riding that wave all the way up. And yes, you might have lost 8% value for 2 quarters, but then on the rebound, you may gain, 5% on what you've earned. Now, to be fair, you're still in the negative 3%, but think about all of that stock that you bought during the downtick and during the recession. So now you're coming into the next year with, although negative 3%, you're still buying, and when the stock goes and finally resettles at what it was before the recession, you're going to have a lot more stock. You're going to have a lot more money in regards to investments. So you're just, the same $6,000 during the recession is going to stretch a lot further. You're going to get a lot more stock. Think about, you're going to Walmart and buying Gucci for $25 and you're selling it when the stock or the price returns to average, and you're selling that same Gucci bag for $1,000. So you're seeing a massive discount now, and buying in now and dollar cost averaging now, it's a great way to get great value. Now, dollar cost averaging is also something you want to continue even when the stock is increasing, because as I said, if you're going up and you just stop putting fuel into the boat, your boat will just kind of wane. It'll kind of start settling back down in the wave, and you won't see as much gain because you're not constantly pumping the fuel into the boat and to crest in the waves and get that more and more wealth retention and wealth gain. So that being said, dollar cost averaging is just a very easy way of setting aside your weekly budget, $125 or less, depending on what your financial circumstance is, especially if you're in college. If you're in college and you're having debt, pay off your debt first. But once you get out of debt, start dollar cost averaging and setting aside a certain amount of money each week to invest and start buying into the stock market. That way you will be on the path to becoming a tax-free millionaire. And once you cap out the $6,000 for the Roth IRA or whatever tax bracket you're in, you can move over to a 401k and start building up that retirement fund. And then that way, when you're dollar cost averaging, you could be dollar cost averaging $500 a week, which, yes, that's a lot of money, and most people will never see that much money a month. So that's an unrealistic amount of money. But then you're having 2 accounts that will be growing to about $3.5 million if you're below the age of 25, and if you're about 20, it'll be worth about $5 million. So you'll have about $10 million in stocks if you dollar cost average consistently into a 401k or Roth IRA and 2 more retirement accounts or just regular investment accounts. Now, with that being said, obviously this was a very long-winded explanation, but this is also to show you how to use dollar cost averaging to grow your portfolio and grow your wealth. Dollar cost averaging is just a good way of making sure that you're not just burning money because you're investing in something and hoping that it goes up 1,000% and then selling it when you buy in and it plummets 8% and it never recovers, as JCPenney did to me. And I didn't dollar cost average JCPenney. I was trading it like a penny stock, which you're supposed to buy low, sell high. And I would buy low and it would go lower. I would sell, buy in because it went lower, and I was like, oh, I can get my money back. It'd go lower. And it was just a losing cycle. So dollar cost averaging, although if you're buying it into an individual stock, is a lot more risky and you're not guaranteed to see gain. When you're buying it into an index fund, a mutual fund, that you see that 7% on top of inflation return, you're going to see that consistent growth. And if you're buying into dividends, you're going to see that dividend return and possibly growth of the stock. So dollar cost averaging is just a very easy way and a non-scary way of investing. Because frankly, had I not started dollar cost averaging after I failed miserably with JCPenney and pretty much lost everything, not lost everything, but lost all my money that I had in the stock market at that time, because I had it all tied up in JCPenney, I would have probably stopped investing. I probably wouldn't be sitting here talking to you and having y'all being money sausages with me alongside the money sausage. Now, dollar cost averaging, I wish I would have started doing that when I first started investing, but at the same time, if you're just starting your investment journey, this is just a good way just to start buying in and just to start seeing consistent returns. because buying low and selling high is very daunting. It can be very scary. And frankly, dollar cost averaging is just a good safety net to see really good returns. And just, as I said, it's just a good way of feeling secure in your investing. It takes the high risk of selling stocks and limits it slightly. Now, if you want to talk about a very high risk way of investing in the stock market, that's shorting and buying options. But that's for another day. So dollar cost averaging, once again, let me read the definition for you so you can have it cemented in your head. By the Merriam-Webster definition, is investments in a security at regular intervals of a uniform sum regardless of the price level in order to obtain an overall reduction in cost unit. With that being said, I hope you understood what's going on. If you have any questions, leave a comment down below. And that's all I have for you today. With that being said, that is today's video. Hit that like button if you enjoyed today's video. Leave a comment down below as to anything you want to see or any questions you have. And hit that subscribe button and that notification bell and become a money sausage yourself. With that being said, it is the Money Sausage signing out. See ya.